According to the AFC report to the nations on occupational fraud and abuse, and this is specifically the 2016 Sub-Saharan African edition, in Tanzania, Nigeria and a number of other African countries, an estimated 20% of government expenditure is lost through corruption. The report also tells us that fraud is prevalent in developed countries as well. Corruption costs the global economy $1.5 trillion every year, and detection only recovers a small amount of this. Every sector is affected by fraud. Fraudsters often work in finance functions, and the majority of fraud is committed by senior management and executives. One of the main motivators for committing fraud is greed. And despite all these facts, many organizations still don't have the formal systems and procedures in place to prevent, detect, and respond to fraud. Hello, and welcome to our Fraud Awareness e-learning session. In the videos that are coming up, we're going to discuss the nature and types of fraud. We're also going to look into why people commit fraud. From a business perspective, we talk about fraud as a risk. We're going to cover the internal controls against fraud and introduce you to fraud risk management as well. Let's get started. In this video, you'll learn about the concept of fraud. We'll also discuss the scope and the different types and forms of fraud. Now, what is fraud? Well, fraud is a broad legal concept that generally refers to an intentional act committed to secure an unfair or unlawful gain. Now, misconduct is also a broad concept, generally referring to violations of laws, regulations, internal policies, and market expectations of ethical business conduct. It's an intentional act by one or more individuals among management or those charged with governance, employees or third parties, involving the use of deception to obtain an unjust or illegal advantage. Fraud commonly includes activities such as theft, corruption, conspiracy, embezzlement, money laundering, bribery, and extortion. It involves using deception to dishonestly create a personal gain for oneself or to create a loss for another party. Now let's look at the different types of fraud that can occur in any type of business. They include bribery, conspiracy, corruption, deception, embezzlement, extortion, money laundering, and theft. And there are various forms of fraud, like crimes by individuals, employee fraud, crimes committed by businesses against investors, consumers, or employees, crimes against financial institutions, EU and or state grant fraud, tax evasion, counterfeiting, and e-crimes. People who commit fraud are usually not career criminals, but rather they're trusted employees. Criminologists in the United States developed a model to find reasons for why people in trust actually commit fraud, and this model was introduced by Donald Cressy and is referred to as the fraud triangle. According to the fraud triangle, all three factors, rationalization, pressure incentive, and opportunity, must be present for fraud to occur. However, the opposite is also true. If any of these three is missing, fraud will not occur. Most fraudsters are first-time offenders with no criminal past and thus do not view themselves as criminals. They must always justify the crime to make it an acceptable and justifiable act, and this is rationalization. They might tell themselves things like, I was underpaid, my employer cheated me, my employer's dishonest, I was entitled to the money, or I was only borrowing the money. A perceived non-shareable financial pressure is the first motivation for the crime. It's non-shareable because it involves some sort of embarrassment, shame, or disgrace. Now, this could be a deep personal debt or a business being in jeopardy. It could also be a desire for status symbols like a bigger house or a nicer car. And it could also include the need to meet productivity targets, drug or gambling addiction, or an inability to pay bills. A person may have financial problems like these that cannot be solved through legitimate means, and this can lead to consideration of illegal acts such as stealing cash or falsifying a financial statement as a way to solve the problem. Only opportunity makes a thief. A fraud involves the use of a position of trust to solve financial problems, and it's critical that the fraudster is able to solve the problem in secret, since the motivation is about status. Accordingly, fraudsters always act in secret, for example, by forcing bank reconciliations to balance when paying a check to him or herself. In corporate business environments, fraud may occur if unrealistic corporate targets force employees to commit fraud, or if internal controls are non-existent or weak or easy to get around, or if there's a low level of employee ethical behavior or a lack of ownership mindset and fraud awareness, but also when illicit business activities are combined with a low level of transparency and accountability, for example, unlicensed sale of tobacco and alcohol, tax evasion, and so on. In this section, we look at fraud as a risk. Operational risk attaches itself to people, systems, and processes, and it's the risk of loss resulting from inadequate or failed internal processes, people, or systems, or from external events. It includes legal, physical, political, and environmental risks. Now, fraud is part of operational risk in any organization. External fraud includes theft, forgery, hacking, and information theft, while internal fraud includes tax evasion, asset misappropriation, bribery, corruption, larceny, or stealing, in other words. Now, take a look at the following chart. You can see the different types of internal fraud broken down into subcategories. Cultural issues, management issues, employee issues, process issues, and transaction issues are all important factors when it comes to fraud. Now, cultural issues include the lack of an anti-fraud policy and culture, and the failure of management to develop a sound system of internal controls. Management issues include a lack of financial management expertise and professionalism, a history of legal or regulatory violation, strained relationships between management, internal and external auditors, a lack of management supervision or staff, a lack of clear management control or responsibilities, and bonus schemes being linked to ambitious targets. Employee issues include inadequate recruitment processes and the absence of screening, usually close internal or external relationships, layoffs or potential layoffs, dissatisfied employees who have access to desirable assets, unusual staff behavior patterns, personal financial pressure on key staff being on low salaries, poor dissemination of internal controls, employees working unsocial hours unsupervised, employees not taking annual leave requirements, or an unwillingness to share duties. Process risks include a lack of job segregation and independent checking, a lack of identification of assets, poor management accountability and reporting systems, poor physical security of assets, poor access controls to physical assets and IT security systems, inadequate internal controls, poor documentation support, large cash transactions, and susceptibility of assets to misappropriation. While financial transaction-related issues include money laundering and foreign exchange and cryptocurrency scams. Let's move on to the financial risk factors of fraud. Financial risks include unrealistic management targets, significant pressures on management, extensive use of tax havens without clear business justifications, complex transactions, the use of complex financial products, complex legal ownership, and rapid changes in profitability, as well as personal or corporate guarantees like mortgage or insurance fraud. And moving on, let's take a quick look at IT and data risk factors. IT and data risk factors include unauthorized systems access, a wealth of malicious codes and tools for attackers, rapid changes in information technology, users not adopting good computer security practices, unauthorized electronic transfer of funds and other assets, manipulation of computer programs, compromised business information, breaches of data security and privacy, or sensitive data being stolen, leaked, or lost. Internal control is a process consisting of ongoing tasks and activities. It's a means to an end rather than the end in itself. Now, internal control is affected by people. It's not merely about policy manuals, systems, and forms, but it's also about people at every level of the organization that impact internal control. It's able to provide reasonable assurance, but not absolute assurance to an entity's senior management and board. The potential risk mitigation tailored to the achievement of objectives in one or more separate but overlapping categories. Proper control is adaptable to the entity structure. It's designed to provide reasonable assurance that objectives have been achieved. It provides a snapshot of the effectiveness and efficiency of operations, reliability of reporting, and compliance with applicable laws and regulations. The purpose of this section is to familiarise you with fraud risk management. Now, the objective of fraud risk management is to take corrective action and remedy the harm caused by fraud or misconduct. It examines the primary cause of the control breakdown, ensuring that risk is mitigated and that controls are strengthened. It leads to discipline for those involved in the relevant actions, as well as those in management positions who failed to detect or prevent such events. It helps communicate to the company's employees that management has made an appropriate response. Before concluding an investigation, the following should be considered: data and information gathering, interviewing techniques, appropriate resources, analytical tools such as data mining, and organisation intelligence information. Once the symptoms of fraud have been found, and additional tests have indicated that there is a strong possibility of fraud, the review enters the formal investigation phase. Now, here are the stages of the investigation. The first step in the process is briefing the management, followed by terms of reference detailing the initial scope of work. Next comes communication with involved parties, for example, internal audit, audit committees, and accounting staff. This is essential in order to be able to determine the extent of the fraud. Only if fraud is known with certainty can the fraudster be interviewed. Next, the affected business areas should be investigated with a detailed audit test, for example, procurement, tendering, wages, cash debtors, and stock, and payroll. And the process ends with a report to the management on the findings, with copies given to interested parties such as internal auditors and the audit committee. The results of the investigation can be used later as educational tools for auditors, fraud investigators, and other employees. The fraud investigation report should include the following items: the circumstances which led to the investigation, the fraud that was discovered and the extent of the fraud, the identity of the fraudster, the effects on the reported profits and financial statements of current periods, the internal control weaknesses that allowed the fraud to happen, and recommendations for eliminating them, a report of any interviewing with the fraudster, including offers of restitution, which might be relevant to management in deciding what action, if any, they should take against the fraudster, and if there's any suggestion that internal auditors have acted negligently, the extent of the claim against them should be included as well. The fraud investigator should consider the potential effects on the company. Now, where the fraud is material, the auditor should modify the audit procedures so as to perform procedures appropriate to the circumstances. Now, depending on the type of the fraud or the error suspected, the likelihood of it occurring again, and the extent of damage to the company. I'm going to list you some of the management tools that we have. If some proof of fraud exists, the management has several options. If the losses are minimal, they can be disregarded and it may be sufficient to tighten controls. In other cases, the fraudster may have his or her employment terminated. If the loss appears substantial, the management can request a more detailed audit to be carried out. And another option is to engage a private investigator to probe the loss and document it for claim purposes or prosecution, or even arrange with law enforcement agents to investigate the matter. To recover a loss from the client's fidelity insurance agents, management should consider filing a claim. According to the extent of the matter, the directors, audit committees, or the board should be alerted. A strong internal control system is not a guarantee against fraud. An entity should have an effective anti-fraud and corruption strategy aimed at encouraging prevention, promotion, early detection, and responding to concerns that are raised. Good examples include screening job applicants and awareness-raising programs for employees. It's important to maintain a sound corporate policy on fraud and to avoid an atmosphere of distrust and paranoia by overemphasizing fraud deterrence measures. A fraud or a potential fraud risk report must contain all the details of the fraud. It must provide a framework for analysing the fraud case. Investigation and reporting should proceed in such a way that the outcome will be litigated. Exact times, data, and names of persons should be recorded. Now, this type of evidence is critical in civil and criminal investigations and litigation. In potential fraud risk reporting, it's important to stick to the facts and to discount hearsay, rumour, or opinion, and record what is relevant to the cause of the incident and its effect. Audit reports on fraud and other improprieties should be addressed to the right person who can take action. The report must enable the company to improve its management and security policies, as well as to detect and prevent fraud. Now it's up to you to turn the theory into action. How can you help to detect fraud? Well, let's look at some of the red flags. I'm going to list these. Keep your eye out for them. Personal interest is one. Uncorrected entries and stock adjustments. High-flying management decisions. Incompatible functions carried out by one person. So this is like a lack of segregation of duties. Then there's also the use of computers for private business. The frequent use of allocated issue vouchers, even when the system is available. Questionable system adjustments, questionable business practices, significant manager or director transactions, flouting directives and regulations, drops in sales and earnings. Then there's aggressive accounting treatment, posting of transactions to headquarters, receipt or acceptance of poor quality goods and services without price adjustments, claim or compensation, and related party arrangements. And then there's weak security checks for employees. And finally, delay in submission of reports. Joe Smith has the authority to approve vendors and amounts paid to them on contracts for goods and services. Now, Joe was approached by a dishonest vendor about an arrangement whereby the vendor would send him phony or inflated invoices for materials or labour, and Joe would approve the payment and then split the excess payment with the vendor. Here's the question: what type of fraud is this? The answer? Corruption. This is a kickback scheme. Kickbacks are undisclosed payments made by vendors to employees of purchasing companies. The purpose of a kickback is usually to enlist the corrupt employee in an overbilling plot. Analysing trends in spending and understanding variances and irregularities can help detect overpayments. Corruption schemes are most often exposed through a tip. Sue Williams was approved to attend a 2-day conference in San Antonio. She's working as a junior assistant researcher on a relatively low salary. Fees for the conference, including the hotel accommodation, were paid in advance. And meals were included as part of the conference fees. Now, Sue chose not to participate in the second day of the conference, but instead took a taxi to the outdoor market for a day of shopping. Now, when Sue submitted her expense report, she requested reimbursement for the related taxi and meals. Here's the question: what type of fraud is this? And the answer? Asset misappropriation. And this is an expense reimbursement scheme. All expense reports should be carefully reviewed and routine questions asked prior to authorizing reimbursement. In this case, inquiries about the conference would be prudent. Expense reports should be accompanied by original receipts verifying that adequate evidence of travel and related expenses occurred. John Jones had been struggling to make his mortgage and car payments since his wife lost her job. As a retail unit, that's a shop manager, he had authority to approve invoices for payment. He used his management authority to establish a shell vendor account, JJ Enterprises, which never provided goods or services of any kind to the retail unit. John used a firm owned by a close family member as the bogus vendor, and he could receive the wire transfers to his company's bank account for his own personal or close family member's gain. The question: what type of fraud is this? And the answer: asset misappropriation. This is a billing scheme. Billing fraud is often perpetrated by deceitful employees who have the ability to approve new vendor accounts. The fraudster then directs the falsified payments to the fake vendor accounts. Be alert to suspicious patterns of vendor payments, including those that are just under the radar in terms of required approvals, reporting, amounts, or other procedures. Strict controls over vendor account approvals might have prevented this fraud.